Today we're talking about one of the easiest ways to get exposure to real estate, REITs.
REITs, or real estate investment trusts, give you the ability to invest in real estate without ever dealing with the 3 T's: tenants, toilets, and trash.
But keep in mind, you're paying someone to handle these headaches, which means your return is going to be lower. And this is going to be reflected in the grade, as you'll see in a bit. So let's look at how REITs stack up on the Fastfire Investability Scale.
If you're not familiar with our investability scale, you can watch this video here, or download our 2025 Invest Like the Ultra Wealthy Guide to Alternative Investments by going to fastfirecapital.com/guide. This guide will go in depth on the investability scale, and it'll show you how REITs stack up against other alternative investments.
Now back to REITs. A REIT is a company that owns, operates, or finances income-producing real estate. When you invest in a REIT, you're buying shares of that company. There are 2 main types: public REITs, which trade on stock exchanges, and private or non-traded REITs, which are often offered through brokers or platforms. They invest in things like apartments, office buildings, shopping centers, warehouses, and even data centers.
Now, let's walk through the investability score for REITs, starting with return potential. Public REITs historically return 7 to 9% annually. You get steady dividends, but limited upside compared to direct ownership or syndications. Some private REITs advertise higher returns, but those often come with more risk and less liquidity. So overall, the returns are on par with the stock market. So we give REITs a C.
Next is risk profile. REITs are somewhat correlated to the stock market, so they tend to move with the broader market, especially during downturns. So again, we're going to give it a middle-of-the-road C.
Last is accessibility. This is where REITs shine. You can buy into a public REIT with just a few dollars on platforms like Fidelity, Vanguard, or even Robinhood. There are no accreditation requirements, and you can sell at any time. That earns them a solid A.
Now let's walk through a real-world example. Let's say you invest $1,000 in a REIT that holds hundreds of apartment buildings. You receive quarterly dividends, and the share price may rise over time.
That's about as hands-off as it gets. But remember, the trade-off is you're not getting the tax benefits or leverage you would with direct ownership. Also note the low minimum, which makes these investments very accessible.
REITs are a great entry point for people who want real estate exposure without a big upfront investment, investors who value liquidity, and those who want to keep it passive and simple.
If you're just starting out or want to dip your toes in real estate, REITs can be a smart first step.
So here's how REITs score. Return potential is a C, risk profile is a C, and accessibility is an A.
Want to compare all real estate strategies side by side? Download our investability scorecard by going to fastfirecapital.com/guide.
And remember to like this video and subscribe, and join us next time as we explore other alternative investments that the ultra wealthy use to build and protect their wealth. See you soon.